With 30-year mortgage rates now approaching 8% and housing prices now higher than they were prior to 2008, even when adjusted for inflation, many people are asking the question, why hasn't the market crashed yet? I mean, the whole thing from an affordability perspective seems eerily similar to the 2008 financial meltdown. But there's a lot that's different. And yeah, I get it, YouTubers, economists, they always say it's different this time, but the reality is, it is different this time. But that doesn't mean that there isn't going to be corrections or a crash. What it means is that the economic circumstances have changed, and in order to be ready for the coming real estate market crash, you have to know which factors to look at. And that's what I'm going to talk about in this video. But before I do, my name's Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit that subscribe button, hit the notification bell, and please hit that like button so more people like you can see this video. It really means a lot to me when you hit that subscribe button, and thank you to everyone who has done it already and those who do going forward. Okay, so let's discuss the US housing market and why it hasn't crashed yet. And I'm going to start by talking about the problems, the things that are propping the market up, and then I'm going to talk about the things you need to be watching, the things that can and will cause real estate corrections and potentially a full-on collapse at some point in the future. So let's start by talking about the lock-in effect. This is a term economists use to describe sticky situations. And that's what we have in the US housing market right now, a sticky situation. And the sticky situation is the vast number of people that have mortgages under 4% that don't want to give up those mortgages, and rightfully so. Because if they were to give up those mortgages and move to a different house, that would mean their interest rates would go up substantially, and so too would the overall cost of home ownership. Payments would go up, everything would get harder. So a lot of people are just staying put, holding on tight to those 30-year mortgages. And it's totally understandable. And that's leading to a lack of inventory on the resale side. But the real issue on the inventory side and the supply side isn't the realtor talk about how many houses are for sale. It's actually how many houses are being built. Because according to a study by the National Association of Realtors, yes, we're going to have to use realtor data for this, between the years of 2012 and 2022, there's a gap of 6.5 million homes that weren't built. And that's no surprise because anytime that there's a major downturn in a real estate market, there's a major downturn in the amount of new construction. So in those years between 2008 and 2012, of course, there were less homes built, leading to a gap between the number of houses that were needed and the actual number of houses that exist. And ironically, this is a problem that nobody saw coming, but we all should have seen coming. Because as millennials reached the age where they were destined to start forming households, pairing up, having kids, doing all the things, we weren't even paying attention to the fact that baby boomers were also living longer and not giving up their hold on their houses easily. In fact, this graph from Harvard shows that the number of households formed by those between the ages of 25 and 44 significantly outweighs the number of households that were given up by those 65 years and older. So in other words, we found ourselves in a situation where we have competing generations competing for the existing household stock, and not enough new houses coming online. And clearly the pandemic and ultra-low interest rates led to an acceleration to this problem. As many millennials started to realize that interest rates were at all-time lows, housing prices were going up, and the ability to buy a home was quickly getting out of their reach. That combined with the fact that as a young adult, people realized that living with mom and dad wasn't necessarily the most fun thing when it came to lockdowns. So a lot of the household formation that would have happened over the coming years got moved into a very short period of time, leading to that increase in housing prices from the increase in demand. And that has obviously led to affordability issues, with the average income no longer being able to afford the average home. But what nobody really pays attention to is the fact that the average home has changed significantly over the last 50 years. With the average square footage of a home in 1970 being 1,500 square feet, and in 2020 being almost 2,500 square feet. So what's actually happened here is not that the average income no longer buys the average home, because it does. The expectation of what the average home is has changed drastically. And there seems to be this impression among young people that if you can't buy the average home, you're just not going to buy a home. And in reality, what happens is people just choose to buy a different type of home. One that's smaller, one that's more reasonable, and one that's probably more in line with the type of house that you would have bought in the 1970s. And I'm going to go out there and I'm going to call a spade on this one. The expectations of young people of the type of home that they should get to live in as their very first home is absolutely ridiculous. Now, that leads us to the gap. And the gap is in the construction of affordable housing versus average housing. And this, in my opinion, is where we're going to see a significant housing boom in the next 10 years. More affordable homes that are of a reasonable size are going to be built. And this creates an opportunity, especially from a real estate investment perspective. If you are the type of person who wants to invest in real estate, the opportunity is clearly in affordable housing and housing that is not McMansions, those ridiculous homes that we expect to buy as our first homes, but in homes that are closer in size to those of the 1970s. And if you're smart and you can get in on this building boom right now, just like Warren Buffett did when he bought a significant amount of shares in different home builders, well, there is an opportunity to become very wealthy off of this gap. Now, that doesn't necessarily mean you want to buy these homes with the expectation of holding them for the long term and seeing them go up in value significantly. That's not what I'm saying here. The money to be made over the next 10 years is in the actual creation of those homes. Because even though the market isn't crashing right now, it is correcting in a way, and it seems that the next 10 to 15 years are probably going to be a period of stagnant growth in the real estate market, especially from a price perspective. But the fact that the market isn't crashing doesn't mean that corrections won't happen and that crashes can't happen either. And there's some things that you can watch for in order to see the crashes coming before they actually do. The first is unemployment. In periods where there have been significant market corrections or market crashes, those crashes are almost always led by rising unemployment, which, by the way, can be the product of higher interest rates. Just keep that in mind. So if you go back and you look at the crash of the 1990s, you can see that the higher unemployment went, the more the market dropped. And in the same vein, in 2008, the same thing happened. The recession started, unemployment started increasing, and that was when the majority of the reduction in prices actually occurred. And in pretty much every significant real estate correction in the United States going back to the early 1900s, there's been a correlation between unemployment numbers and a reduction in real estate values. Now, as of right now, we haven't seen a significant increase in unemployment. In fact, unemployment is at one of the lowest rates that it's ever been at. And as long as people remain employed, there's a good chance that the real estate market won't have a significant crash. There may be corrections, but a significant crash may not be on the horizon if the unemployment rates remain low. But if higher interest rates cause companies to start cutting jobs, and that trickles down through the rest of the economy, and we see a significant uptick in unemployment, you can pretty much rest assured that we will see a decrease in home values. The reason why is because when people don't have money to make their mortgage payments, they tend to go into delinquency and then foreclosures happen. Now, if we find ourselves in that situation where that happens, that could lead to the next domino, which is investors unloading properties as the market turns. And there's no question that we've seen an increase in investor activity over the last couple of years, which means there are properties that are being held by real estate investors that, in the event that the market turns, could be offloaded very quickly. And if this happens, it could mean an influx in resale inventory, which could put excess downward pressure on housing prices. This is exactly what happened in 2008. The real damage was done when investors started offloading properties. And then last but not least, the other thing that could lead to a major crash in the US market is something that's completely unforeseen. Something that causes unemployment and then the other dominoes to fall, something like the banking collapse that happened in the Great Recession. But quite honestly, it's the things that are unforeseen that have the greatest effects on the real estate market and on the economy in general. And we won't know what those things are until they happen. But as of right now, the reason why the housing market isn't crashing in the same way that it did in 2008 is because the circumstances are different. The lending policies are different, household formation is different, the lack of supply is different, and different doesn't mean safer, it just means different. So the reality of today is that if everything stays the way it is right now, we'll probably see an extended period of time where housing prices are flat. Local markets may have corrections or crashes that don't filter through to the rest of the country, but in general, it's going to take something pretty big and something similar to what happened in 2008 in order for the market to actually crash. Oh, and if you want to see more on what could be the biggest real estate crash in history, make sure to check out one of these videos right here.